Welcome to the Bucket Plan on Demand, a podcast for financial advisors based on the best-selling book and process that simplifies financial planning. Hear from skilled industry professionals and special guests each episode that will help perfect your approach with clients and your results.
Greetings, everyone. My name is Kalem Mackey. I'm the Executive Vice President here at C2P Enterprises. Very happy to be joined by my guest today, Dave Alison, who is the President and Founding Partner at Prosperity Capital Advisors, and of course at C2P as well. Dave, great to have you.
Yeah, it's fun to be here. It's good to be sitting on the other side of the microphone today.
Yeah, I get the hosting duties today. So our topic today is preparing for a hypothetical 2024 and talking about how the upcoming election, we're getting very close to election day here in November, how that election might impact your finances. Before we jump into any of our topics of discussion today, it's just worth prefacing that what we're going to be discussing is going to be based purely on hypotheticals. I don't think you know, Dave, yet how the election is going to turn out. So we're going to be discussing a number of hypotheticals. As we go through, we might jump around a little bit. We might jump into some more specific topics, talk about some things in a little bit more general sense. But the main takeaway, I think, is it's not always best to take immediate action just because we're in an election cycle. I think there's a tendency for people to say, hey, let's jump in and make some changes, anticipating what's going to happen. But that's not always the best course of action. In kind of thinking a little bit maybe more globally as we start, Dave, when it comes to the upcoming election, what are some of the hot topics you're hearing, you're discussing with your clients, you're hearing from other advisors, and why maybe those are the most relevant topics right now?
I think, Kalem, there are some certainties with the election. We know that either Kamala or Donald Trump will be president. So we believe that's the case, right? I guess anything could happen.
I was going to say, given what's happened so far, I don't know that I'd put 100% on that, right?
We've seen some wild turn of events over the last few months, but we are 38 days, 17 hours, and 52 minutes away from election time. So we know we've got a little bit of runway here with some more uncertainty. I think having more of a balanced approach and mindset, depending on what your client base looks like. I was actually just talking with Brian Bibbo. We were on vacation this past week about this. And if, let's say, your personality and personal perspective is dominant towards one political party or the other, and your client base is pretty much dominated by that political party and belief system, then you might go a little bit more towards being open and taking positions on certain candidates or certain policies. But if you have a practice that is more diversified in terms of who your clients actually are, I think the best approach is just sticking with the facts, right? I don't think we get facts from very much of the major news stations or media out there. And what you can try to do is disconnect the personal beliefs, and so much of politics is around personal perspective, and try to stick with the facts around financial decisions that should be thought about, what happens in markets during election years, what the potential ramifications from a tax policy perspective are. And these are the things that I try to stick to with my clients. For example, we know that markets don't like uncertainty, whether it's geopolitical uncertainty with wars that are going on, whether it's economic uncertainty with interest rates and the labor market and GDP growth, or whether it's election uncertainty with the unknown of who's going to rule the country come November. And so anytime there's an elevated amount of uncertainty, there's typically an elevated amount of volatility in the stock market. And unless the client is trying to shift from being an investor to a trader, there's probably not a lot of reason to change around their investment strategy and portfolio. Like when I talk to my clients, I say, look, we take a more macro position on our investment portfolios. We're not trying to think about what happens over the next 30, 60, 90 days. We're trying to think about where we should be invested as we look at what's going to happen in the world over the next 2, 3, 4, 5 years. And yes, there's going to be changes with politics and the election, but we feel like we need to stay the course from our investment portfolio because while we might experience volatility over the next 30 and 60 days, which I will pretty much guarantee we will, right? It doesn't mean we need to deviate from our strategy. And again, it just really depends on who you're talking to. Like I have clients that are like, if Trump becomes president, we're moving to Canada, we need to cash out of everything. And I have some clients that are like, if Kamala becomes president, the world's going to go to chaos and it's going to be 4 more years of this or that. And we all hear these perspectives on both sides. I always talk to clients about the fact that the market is not driven by who's in office. The market is driven by a company's ability to generate earnings and innovate. And it's more about valuations than votes. And could the president impact certain factors in a market? Yeah, of course they can, right? It would be almost negligent to say that they don't. But it's like they only impact one of 40 things that could impact a stock's price. And the best bet, if you look at almost every historical perspective in an election year from a market return profile, is just don't act irrationally. The markets in an election year tend to do well in the first half. They tend to become very volatile in August, September, October. And then they typically start to normalize in November and December and provide a strong end of year performance outlook. And your clients, you just have to remind them to zoom out, leave their personal politics to the side. Don't allow that to come into their long-term investment strategy. And the second thing that I'll say is you could also play the other side of the fence and ask the client, do you think there's areas that you feel you could try to speculate and add a bunch of risk and uncertainty in the effort to try to get ahead? Are you going to want to allocate a position or a certain amount of your money to try to be a trader? Do you think you want to make a bet on small caps because you think Trump is going to get elected and deregulate and make business easier for small companies? Or do you think Kamala is going to get elected and you want to maybe invest in companies that are part of her bigger picture agenda? But the clients need to understand that those are purely gambles. They're purely speculative bets. I remember going back to when Biden was elected last election, I had clients coming to me saying, should we invest in green energy? Should we invest in EVs? Should we invest in companies that kind of support that agenda? And I would challenge anybody listening to this podcast today, go look at what the returns have been over the last 4 years of those sectors compared to just like the S&P, and they've greatly underperformed. Trying to pick those bets are very challenging. And when you put that on the client and say, so do you want to try to become a gambler, a trader? And if so, where do you want to take risk? And how much do you want to take? For me, it's all about how big is your stake. If you're like, hey, I want to go throw 10 grand of my $2 million on this, yeah, go ahead. Who cares, right? But if you're like, I want to put 30 or 40% of my net worth, or I want to go to all cash because I think the markets are going to crash if X, Y, or Z gets into office, that's a much bigger ramification if you're not on the right side of that bet. And I'm talking to clients about the evidence. I'm talking about leaving their personal biases off to the side. They're important, but they're not important to drive your investment portfolio. And then I'm talking to them about whether they want to actually try their hand in trading. And if they do, what's the size of the stake that they want to put out there? And how could that impact their long-term financial plan? And when I do that, guess what happens at the end of the conversation? They 10 out of 10 times say, you know what? Let's just stay the course with what we have. I think you're right. But they need to be heard, and you need to explain to them the facts.
I think you also, a couple things you said there, right? Like you said, you're prepping them for volatility. So now they expect that, hey, the markets may be volatile over the next 30, 60, 90 days. We expect that. May or may not come to fruition, right? We don't know, but at least they're prepared for that. And you're bringing their perspective back to the long-term focus. And I think that's the key, right? I think some people get caught up in, they're so caught up in their worldview that they're like, and again, obviously the media plays into this of it's doomsday if one candidate wins or the other, depending on which side you fall on. But it really isn't, right? In the terms of the market and in history, it's never been that way. And it's just having that conversation, like you said, bringing them back to this is the plan. We're not going to really deviate too much unless maybe you want to like take a small pot of money and go make a play. That's fine, right? That's totally fine.
Yeah. And then it's reinforcement. So I think it's communication on the front end. Like I know since pretty much this whole year, I've been having this communication with my clients. Hey, the market's doing well. It's up nice for the year. We're doing great, but it's going to get bumpy. Like it is going to get bumpy. That's just a fact of election year market cycles. And doing the proactive communication on the front end. But then I think it's important to do some reinforcement on the back end because we all don't have nerves of steel. We turn on the TV, we listen to the media, we see different conflicts going on, and there's just a lot of noise and misinformation. I'll give you an example. I had a client, pretty high net worth, they have 5 or 6 million invested with me in their late 60s, approaching retirement. And right at the end of July, early August, we had our annual review and they were like, hey, my gut's telling me there's some really bad things that are going to happen in the market. Like to the point, maybe we want to get out of the market. Like we're up, I don't know, at the time, I think they were up like 13% for the year so far. They're like, we've had a pretty good year. What do you think? And I was like, look, there's going to be a lot of volatility over the next few months leading up to the election. But if we allow historical data to help guide some of our decision-making process, it typically says if we can wait this out, once the election is declared and we know who the president will be, things start to calm down. Markets typically do well in November and December. You might have heard of the Santa Claus rally before. And in the first year of a presidential term, markets tend to do pretty well also. And so like my recommendation is like nothing has really changed from the companies that we're investing in and the strategies that we're investing in. The labor market's still good. The economy seems to be doing pretty well. I think we should stay the course. And he said, Dave, this is why I hired you. Let's go ahead with your recommendation. Here we are. And it's been 2.5, almost 3 months since President Biden declared that he was not going to run for re-election. Kamala is now, the Democratic nominee. And I've reiterated with him, I said, you remember how like you were really uncertain and we decided we want to stay the course? Like the S&P's put up 5% since then. On $5 million, had he been out, that's $250,000 less that he would have if he would have maybe panicked or deviated from his investment strategies. As we all know in this industry, it's just about communicating with clients, whether it's good news or bad news. It's just about communicating with them and staying in touch with them. And I think if you can drop little communications and messages, especially to some of your clients that are a little bit more politically fueled. Like I have a couple clients that I know I just need to schedule an extra 20 or 30 minutes in their annual review, and I need to let them vent about what's happening politically. Right. And they just want to be heard in some cases. And then you need to provide them some historical perspective and make sure that they're making informed decisions.
We've talked about the messaging kind of leading up to the election. What we do know is one of these candidates is not going to win on election day, right? That's another certainty. We can say one of them is going to lose. You obviously are serving sometimes probably polar opposites with your clientele of political positions. Is there a messaging you plan to go out with or a communication plan? We know someone's going to lose. Do you have a plan in mind of, hey, this is what we're going to do post-election just to kind of maybe calm some nerves? Because I do think there are some people that are going to freak out if their preferred candidate doesn't win.
Yeah, 100%. Again, I think it goes into the communication. And yeah, you're right. I have some very probably more prominent Democratic supporters. And then I have some that are on the complete opposite side of the spectrum from a conservative angle. And then quite honestly, a lot of my clients are more in the middle, which seems to be like a crime these days. They're more independent and could certainly flow either way. But I think it's continuing to line them with credible information on how the stock market performs pre-election, post-election, within the first year of a presidential term. What's interesting is we know some of the playbook, like both of these candidates have been in the White House, right? There's not that level of
Right.
uncertainty of the total. Maybe some would say some of these candidates are wild cards, but we've seen what Trump has done. We've seen what Kamala has done, even though she wasn't in the total driver's seat for her
Part of the administration,
term.
right? Like
Yeah,
we
the
expect there to be
administration.
more of an extension than radical change.
And the other thing, like I always try to bring constant reminder to is like the president does not have full control in the United States. Like we have a checks and balancing system. And so the reality of it is if Kamala gets elected, but then she doesn't have control of Congress or the Democratic Party doesn't, she's going to have a very hard time getting a lot of her proposals enacted into law. And the same goes for Trump, right? If Trump gets in as president and they don't have control. And so this is something, again, like politically, if you don't like one of the candidates, if you're like, oh, I don't want Donald Trump to be president, but I don't like Kamala's policies, you can vote for Kamala as president and then try to vote Republican for the House and the Senate, right? And try to keep a divided Congress. And so I think like the interesting, obviously, opportunity is if there's a red wave or a blue wave across the White House and then Congress. But even when it comes to tax proposals, like I know Kalem and everybody at C2P hears me talk about tax proposals all the time. The chance of these actually getting enacted are very low because it's going to take a unified Congress and the White House to get a lot of that done. What I tend to look at more is what is the authority of the president under executive orders? What type of stuff could they get done there? Because that's much more likely. And that's another area, like if you were going to look at speculating and investing based on pure gambling and speculation, what could the president do under an executive order versus what could they do under bipartisan reform through Congress and the White House? But I think it's reminding them of what the actual power of the president is. And then the other thing post-election is a lot of our partners, I know I use a chart by Dimensional Fund Advisors. They've shown what the average returns have been under a Democratic president, as well as what the average returns have been under a Republican president. And the punchline is like they're within, I think, 30 or 40 basis points of each other over the long haul. So again, it just shows people the facts of try to remove your emotions. We know from Behavioral Investing 101, emotions can devastate returns and they can make irreversible mistakes in a client's financial well-being. So, it's pre-communication to your point right now, and then it's post-communication just to continue to reinforce why they, number one, have you helping them navigate this, but number two, why they shouldn't let their emotions drive their investment strategy.
Yeah, you make a really good point. I think so many people forget the president doesn't set tax policy, right? They don't set a lot of these policies. A lot of the proposals we've heard from both candidates would have to be enacted through Congress. And historically, when Congress is divided or the president and Congress are different parties, you have a lot more gridlock. You don't tend to see these big changes, right? You don't tend to see, I look at the Tax Cut and Jobs Act. That was done when President Trump had a red Congress to back him. You go back to Obamacare. That was a blue Congress backing Obama. Like those bigger kind of major legislative changes tend to come when you have one party rule. But I always also go back to the Senate's filibuster requires a majority of 60, which is highly unlikely in any election cycle. So reality is you always have, as you said, some checks and balances that are going to really stop, especially if the president and Congress are different parties, anything huge from probably taking place.
Yeah, I think that's pretty fair to say. And there's obviously some outliers. Trump got the Tax Cuts and Jobs Act passed through budget reconciliation, which he didn't need supermajority. He was able to get it done with a simple majority. That's why we have all these sunsetting provisions of the Tax Cuts and Jobs Act. If you look at presidential terms, pretty much going all the way back to Clinton, every president's been able to get one big piece of law done. If you think you mentioned Affordable Care with Obama, we can look at Biden's Inflation Reduction Act. We can look at Trump's Tax Cuts and Jobs Act. And this goes back through Bush and Clinton. So you can pretty much bet whoever gets in will probably get some piece of reform done, but whether they're going to need super majority to get it done, or I think some of these like really outlandish things are just low probability events, like a wealth tax or reducing the estate and gift tax down to 3.5 million and a 60 or 50% rate. Like some of those things are really important for clients to know about because it brings awareness, but it's not things like I'm making irrevocable decisions in my client's wealth plan today because of what a potential candidate is proposing. We still have a lot of runway to do good work and good planning. And that's where I reinforce my value to my clients is I'm staying in touch with all of these things. I'm looking at what the candidates are proposing. I'm thinking about how it could impact my clients, how it could impact their investment portfolio, how it could impact their estate plan, how it could impact their taxes. But we're thinking like a game of chess, 2, 3, 4 moves ahead, and we don't need to make the move now. But wouldn't you want an advisor who's proactively thinking about this stuff? And I do it so that my clients don't have to, so they can go enjoy the things that they want to enjoy in life. So all of these things, this kind of chaos that's happening right now, if you will, is such an incredible opportunity for an advisor to, number one, educate themselves. Then number two, be a messenger and communicate the value proposition of having a wealth management firm that is proactively looking at all of this stuff and making strategic decisions on behalf of the client.
Yeah, and I think, again, it just goes back to they hired you for a reason, right? Part of that reason they hired you is to you're the one looking at this stuff, looking at all the different things that could happen, educating your clients on, again, you mentioned the Tax Cuts and Jobs Act. We know right now it's scheduled to sunset. 2025 is the last year, starting the 2026 tax year. That's when the tax laws are going to revert back to effectively 10 years ago or 8 years ago or however long ago it was now. Those are things I think you can educate on until we don't know what's going to happen ultimately. And a lot of it's going to depend on this election cycle of what does Congress look like? Who's in the presidency? Obviously, president has veto power, so they do wield a tremendous amount of power. But ultimately, it's Congress that has to present and propose and then pass tax legislation.
Exactly. And I think this is a big marketing opportunity for advisors because clients are worried, right? They are fearful. That's natural. Think about what I've made the mistake of talking politics to some friends before. And it's amazing how like alienated, you can become if you guys aren't in agreement on every issue. And I think that clients are feeling that uncertainty. And if their advisor that they're currently working with isn't helping them bring some perspective and some facts, then that's an opportunity for you to maybe create a wedge. There's probably going to be a lot of clients that turn over advisors through this election year cycle because they're not getting the communication that they want, or maybe they're not getting the message that they want. My probably fourth biggest client, I remember when they hired me about 2 years ago, they said, Dave, one thing we ask is don't bring your political perspective into the equation. They don't even know what mine was. So it wasn't like saying they disagreed with me. Like we might agree on everything. They just said, don't bring it into our meetings. Like we are leaving our other advisor because we couldn't stand listening to their politics all day long. And does that mean they don't want evidence on investing that is related to political issues? Absolutely not. I bring them the facts, but I don't put my personal biases or perspectives on that. And I think that's really important to understand with your clients. Like what I was talking with Brian Bibbo the other day, one of the interesting things is I was watching this advisor who is one of the he has a big RIA. He's on Fox News and his model is literally to bash anything that's more liberal, and he's just very narrow focused. Again, we've heard niches make riches. And if you're, what I was telling Brian is if you're passionate about politics and you're conservative and you're willing to alienate any client that's not conservative, that could be a really unique niche market to go or vice versa on the other side of the political spectrum, right? If you're more more on a liberal or a democratic side, and that's where you want to focus your time and energy, there's a marketing opportunity for that right now. I know for me, I'd probably lose half my clients going one way or the other because we have a pretty mixed bag of clients, and that's not what I also want to do. I don't want to. I'd rather have a niche like in equity compensation or something versus being a political talking head and really just focusing on attracting clients that way. But again, like that's a unique opportunity advisors can be thinking about depending on how they want to position themselves in their practice.
I do want to give you a chance maybe to speculate, forecast. There's been a lot of proposals that have been from both sides, from Trump, from Kamala Harris, from both campaigns. Is there any that you think do have a good chance of maybe becoming law, or a better chance than others of ultimately becoming law? Obviously, one that came up was like no tax on tips, right? Both campaigns threw that out there. Now, that just might be red meat to get some union votes. Is there any that you have seen or heard that you're like, hey, this probably has a good chance of at least having a shot in Congress of getting through? And especially since we know there has to, and most likely, because there have to be, but most likely there's going to be some tax legislation that's worked on early on in the next administration.
Yeah, I think the interesting thing, and I don't want to get too political here, is like how much of a, what I would call it like a Christmas tree bill is it going to be, where like Christmas tree bill is everybody just goes and gets to hang a random ornament on it to get their way and get some bipartisan relief. I've been saying this for a while. I think there's actually a number of elements of the Tax Cuts and Jobs Act that probably won't sunset. I think they'll get extended. I think that neither party wants to raise taxes for the lower bracket individuals. I think we've seen and heard that number of 400,000 of income. I don't know if that'll be the number or not, but if I was going to speculate, and again, I was going to take a small stake and do some gambling, I would probably bet that we'll see a number of extensions of the Tax Cuts and Jobs Act for the majority of the people, which again, the majority of the people are not people over 400,000 of income. So I think that's certainly one. And I don't want to speculate on any of the social issues. There's border, immigration, geopolitics, war, but tax policy wise, that would probably be my bet, is there's going to be certain provisions that will sunset, probably the estate exemption. I think brackets will increase for higher income individuals. I think that you could see a parity in like higher long-term capital gains rates for, again, high income individuals. If I was going to do a spread bet, I'd probably say taxes are going to stay somewhat neutral for the lower brackets and taxes are going to go up for the higher brackets. And I don't think that's going to be that difficult of a piece of legislation for them to get approved in a bipartisan effort if all these politicians are trying to attach other bills and spending to that.
So that always seems to be the common one, right?
The conversation I'm having with my clients is we want to do things that no matter what happens, they're not really worse off. Like doing Roth conversions in low brackets, I think that's a no-brainer. Taking a client that maybe has 8 or 10 million and gifting a bunch of their investable assets to an irrevocable trust, like that's got a lot of table stakes to it. That's not something we're doing right now. Taking a life insurance policy and gifting it to an ILIT today, to me, that's a very low impact, high reward strategy for somebody that could potentially have an estate tax later on, because we have a huge gift exemption today. So if estate tax thresholds come way down, they're much better off by getting that out of their estate today. But if exemptions stay high for a long time, they're no worse off by having that life insurance policy owned by an ILIT, other than the nominal cost that they had to pay for an attorney to draft the ILIT. So those are the conversations I'm proactively having with my clients today based on a little bit of the game of chess of where things might go. My clients that, of course, have 30, 50, 100 million, like we're doing more proactive strategies because they could afford to gift $27 million today and they still have a whole bunch of money in their taxable estate and they're no worse off either way. It really just comes down to who you're sitting down with.
No, I love that. That was going to be my question. If there's, based on your perspective, if there's any kind of just table stakes planning you're doing, where you mentioned Roth conversions, you mentioned for certain clients probably looking at least getting an ILIT up and running, even if you're not, doing an estate transfer. Your higher net worth people, it's not going to matter one way or the other. They're already above the exemptions. Anything else, any other planning that you're, especially for, let's say, that mass affluent market, that you would see Roth conversions, as you said, I think it is a no-brainer. Is there any other kind of planning like, hey, I would just do it no matter what? It's gonna not harm you, but it does prepare you for the future regardless.
Yeah, I think, like we said, Roth conversions. I think charitable giving is still an interesting thing to look at. And the pendulum is, if taxes are low today and we think they're going to be higher for a certain demographic of people later, does it actually make sense to delay your charitable gift till later, where that charitable gift will actually offset a higher marginal tax rate? Or does it make sense to gift now, particularly if we're gifting highly appreciated assets to a donor advised fund because of the time value of money of the tax savings, but because asset valuations are at an all-time high right now, and there's no guarantee of what could happen in the next 1 or 2 years. So we're having those conversations around charitable giving now and thinking about a strategy and a plan. The other thing is just, again, going to asset valuations and concentration risk. We're realizing some gains in diversifying. Like, one of the biggest mistakes that I see advisors make, and I think we all become beholden to this a little bit, is letting the tax tail wag the investment dog. And we don't want to sell a portfolio and realize capital gains. We want to continue to defer, but our portfolios are getting out of whack. I had a new prospective client that's worth about $5 or $6 million, business owner. Most of their business is tied up, or most of their net worth is tied up in their business that we're building an exit plan for. They're going to sell next year. But they sent over their 401k and IRA statements, and guess what they owned? They own one fund. 100% of their net worth was in a Fidelity S&P 500 index fund. And I pulled up in Quanti and I showed this client that 30% of their overall net worth outside of their business and their primary resident is in 6 stocks. We know the 6 stocks: Apple, Nvidia, Microsoft, Google, Meta, and I can't think of I know I'm missing one, but you get it, right?
Yeah.
And I said, how do you and this guy's in tech too. I said, how do you feel based on today's valuations of these 6 companies that 30% of your net worth today is in these? If you gave me $500,000 and I came back and said we should buy into 30% of your $500,000, 150 grand into these 6 companies, would you question that recommendation and say, that seems like a lot going into these 6 companies, given that they're all at all-time highs and have had meteoric increases in value? And he was like, yeah. He was like, that doesn't sound like a good thing. And I said, well, you own one S&P 500 index fund. That's what you own. Maybe it's time to realize some of these gains and redistribute some of this money. I said, I'm still super bullish on these companies. I love what they're doing. I think they're innovating AI, but maybe there's some other opportunity too to de-risk. And those, again, are popular conversations we're having with clients, that some of them are like, nope, I want to stay. I'm all in on these companies. Let's go to the moon. But they at least understand the risk that they have. Whereas others might be like, yeah, let's look at rebalancing a portion of the portfolio and diversifying.
Absolutely. No, that's another great point of just looking at where, again, nothing to do with the election, right? That's just some other planning you can be doing just in preparation for maybe some more volatility, or just good time to more about where the markets are this year, if nothing else.
It's nothing to do with the election, but it's everything to do with the election, because the election is driving uncertainty, and people, in order to really size up their risk, have to be aware of these things. Like, Kalem, you've been a wealth manager and advisor forever. Like, how many clients that own the S&P 500 would think that 30% of their money is in 6 companies?
They wouldn't.
They don't. They think they're diversified. And if they're worried about election uncertainty, one of the things we can do is help them de-risk their portfolio, right? And maybe if the market continues to go up and to the right, they might miss out on some future return. But if that gives them more peace of mind, then I tell my clients all the time, it's your money, it's your decision. It's my job to educate you on the trade-offs and make you aware of these things. And so maybe if you are concerned about the election and the uncertainty in the markets and the economy and the geopolitical issues that are going on, maybe we should rebalance some money from that into the soon bucket. It doesn't mean that's permanent. Maybe if you feel like some of your fears and anxiety are easing, we can slowly start to dollar cost average that soon bucket back into your later bucket. That's completely okay. That's quite a rational thing to do if it'll let you sleep better at night. It's your money, it's your decision. It's my job to help guide you and provide you perspective and the evidence. And not everybody can stay fully invested in times of extreme volatility, which we're seeing.
Any other things with this election? One other thing that I always think about that just always flies under the radar for me is typically we see a new Fed chair with a new administration. That's another thing that becomes a little bit of a wild card as it relates to obviously interest rates and where those go. Anything else you see or discussing with clients that we haven't covered as it relates to really an administration change is what we're looking at one way or the other.
Certainly, these topics come up on administration changes and their overall impact. I think, again, a big part of Trump's platform, and what does he call himself? The Doge person now, with Elon joining the Department of Governmental Efficiency and sitting on that. Like, you think about what impact that could have if it really came to fruition, if the government decided to start cutting back a lot of their areas where they're spending an insane amount of money. I think the government spent 40% more than what their budget was over the last 12 months. Those dollars need to find a home. Stoyan and I were talking about that from an investment committee perspective. Now, what's driving markets right now? When the government spends $400 billion more than what they budgeted, those dollars have to go somewhere. So I think you start to look at administrative changes, but again, it's pure speculation at this point. I don't even know if both candidates know exactly who they would put in to their administration. And then with one candidate, we know, he's got some higher turnover than maybe other administrations when it comes to people that are working around him. All that, again, becomes speculation. Again, if you want to trade, I don't know. I think on DraftKings, they allow you to bet on some of this stuff now. That might be a better place than actually
investing your money. Just go bet on it in the betting markets.
Yeah, bet on it in the betting markets. Leave it out of the stock market. Use that as your gambling money. That's really, again, perspective. What the Fed does, I think it's pretty clear. The Fed has a mandate. They've been pretty open and transparent with it of bringing down inflation, which it seems like they've done, keeping the labor market stable, which so far, so good. We just had a good GDP number to the surprise upside. I think it's going to be pretty consistent on what the Fed does over the next 12 months.
Awesome. Any final thoughts? Any final words of wisdom? Just
communicate. Your clients pay you a lot of money for you to communicate with them, right? Sometimes we find that it's not about making shifts in the portfolio. It's just about communicating why we're doing the things that we're doing right now. Use our resources. I know if you're with Prosperity Capital, there's great resources on the portfolios where we're bringing some top minds to provide perspective. I think everything that I shared here is not going to contradict a lot of the stuff that we see in the portfolios. And so use that third-party credibility, use that research, read through the market commentary that we're putting out each quarter, join the town hall meetings where we're bringing people like Dr. Apollo Lupescu on who can really provide the evidence behind the decisions that are being made in the portfolio. And nobody is ever going to fire you for over-communicating with them. Do it via email, send out Loom videos, send out Little Bomb videos. I don't have the time to go meet with every one of my clients every quarter or every month to talk about what's going on politically, but I could shoot a 3-4 minute bomb video just letting them know, hey, Kalem, I was thinking about you. I know there's a lot of uncertainty going on. We saw a lot of volatility over the last 2 months. Just want to let you know we're on top of it. We feel like when we zoom out over the next 2 or 3 years, you're going to be real happy with our strategic investment portfolio we built for you. But we know there's going to be some bumps along the way. If you have any hesitations or want to talk about anything, please, my number, reach out to me. Like little bomb videos like that, little communication, it goes a long way.
Fantastic. No, you're 100%. Educate yourself, use our resources, leverage our team. Obviously, we're here to support you, especially at PCA. and then educate and communicate with your clients.
Listen, don't forget, like, not everybody needs to be in a full tilt equity portfolio. Diversify, look at alternatives, utilize guaranteed products to provide peace of mind. One of the things I remember when we were starting C2P, Jason always used to say, and he still does, that the soon bucket prevents freakout risk. When clients have guarantees in their plan, yeah, the trade-off is they might give up some upside, but they're going to be well protected if there is volatility. And some of the best things that we can do as an advisor is protect our clients from freak out risk. And listen, the election's going to come and go. There's going to be more geopolitical issues. There's going to be more economic issues. Like, this stuff never stops.
Nope.
And again, the more we can do to over communicate with our clients and keep them in a good allocation and staying the course, the better they're going to be.
And that's a recommendation you can use all the time, right? No matter the time frame. So thank you so much, Dave. Appreciate your wisdom, your insight, obviously sharing just what you're doing with your clients. And I think there was a lot of valuable takeaways from today.
Awesome. Happy to do it. If any of our advisors need me, they know where to find me also. So look forward to our next one.
Thanks for tuning in to the Bucket Plan on Demand, brought to you by C2P, an organization whose purpose is to educate, train, grow, and support holistic financial advisors so families can achieve true prosperity. Subscribe today for the latest episodes and insights. Visit c2penterprises.com to learn how we can help support and enhance your advisory business. At the time of delivery and any subsequent publishing, information was deemed reliable, but is subject to change by the time of listening or viewing. The contents of this piece include options and projections of C2P, are subject to change, and are for informational purposes only. The information provided in this presentation is not intended to be individual investment, tax, or legal advice.